Thank you all for being here. It's 5 o'clock. We'll go ahead and get started. Call the Human Resources Insurance Committee to order. Jody, would you please call the roll?
Phil Dunlap. Phyllis Crisp. Here. David Merle. Sheriff Blount. Gary Farmer. Here. Grady Caskey. Mike Taylor. Here. Tom Stinnett. Here. Mike Lewis.
Here.
Mayor Mitchell.
I think we can count him as here. Mr. Mayor, you're not absent.
Okay. You're good.
All right, we have a quorum. John, if you would play the emergency announcement, please.
Before we get started, let me read the emergency evacuation procedures. In the event of an emergency evacuation, an alarm will sound. Everyone should exit the building by way of the nearest stairwell in a safe and effective manner. If the nearest stairwell is blocked by smoke, use the other stairwell. Do not use the elevator. Once you have reached the main floor, follow the exit signs to exit the building and quickly proceed away from the building. Please be mindful of others evacuating and of emergency vehicles.
Okay, I would take a motion to set the agenda.
Motion to set the agenda, Mr. Chairman.
Thank you. In a second. Okay. I'm sorry, Bill, go ahead.
But anyways, I'd like to move item 6 up to item 5, please. Reverse those two.
Very good. Without objection, we'll switch item 6 and item 5. We'll discuss voluntary worksite benefits first, and then have presentation on current benefits. Okay, you all should have a copy of the minutes from June the 16th. I'm sorry, jumped ahead. Is there any public input on items on the agenda? Seeing none, take a motion to approve the minutes of June the 16th. Motion by Ms. Crisp, second. By Commissioner Kaler. Any other discussion of the minutes? All those in favor say aye. Aye. Any opposed? Okay, just to preface, we're now at item 6, which we have switched, with a discussion regarding voluntary worksite benefits. Cole Harris is going to make that presentation. Cole, if you would go ahead and come up, and would just preface this to say that this information that's being presented is, number one, a lot of information, and number two is information only. So this is going to be more information than we can process in this meeting and try to make a decision. We will meet, we will have a called meeting on August the 3rd, which is a Monday, 2 weeks from today, that we will actually need to make decisions at that point. So this would be the proper place to digest some of this information, ask any questions of Cole or Jenny or Dawn or whoever here that can answer those questions, and try to get as much of that done this evening as we can, and then be prepared to act on August the 3rd. And with that, Cole, I'll turn it over to you.
All right. Thank you, Chairman. As Mike had just mentioned, this is going to be a lot of information, and today is really just going over the recommendations. So we've gone over some of the data in the prior meetings. Some of the requested information from the last meeting will be discussed in this meeting as well. through the PowerPoint. So please bear with me as we go through a lot of information. We're going to start off with the worksite, as mentioned on the agenda, and then move on into the employer side of it. So without further ado, as we've discussed in the previous meetings, first want to get into the scope of the project. The stop loss, slide. Okay. Okay. Are we good? Okay. All right, great. So as far as the carriers marketed, your stop loss renewed on July 1st, so we'll go into that in the second part of it. The ancillary coverage, that's going to include your life insurance, disability insurance, your voluntary life, your voluntary vision, your dental insurance, as well as your your accident, critical illness, and also known as the worksite product. So we looked at 17 different markets for your stop loss, which is quite a bit. And then also your ancillary, we looked at 19 different companies. Inside your packet, I believe you have an actual list of each one of those carriers that we looked at. The majority of them declined to quote. So what they have the ability to do is decide not to offer you a quote, and a carrier will do that if they feel like they are not competitive. So instead of throwing a non-competitive quote out there, they'll just decline to offer one altogether. For their purposes, it works out better. Other carriers simply just did not respond in a timely fashion. We received, I believe, one quote back today, and then one on Friday and Thursday. So they're still trickling in. I received questions from Hartford today. So it's a matter of they'll continue to trickle in, but I think we have the best proposals today, so that we're going to have. PBM, that stands for Pharmacy Benefit Manager. That is going to be 10 different vendors that we looked at. And then ASO, that stands for Administrative Services Only. That would be akin to your current Humana platform. We looked at 6 different platforms there. Unfortunately, in today's market, there's not as much competitive nature with that. So first, let's start off with the voluntary vision. If you look in the top right corner, there's a ticker. It says $0. The reference for that ticker, it's going to be on each page accumulating. That stands for how much money either we're saving to that point in the slide projection or that we're losing. So you'll see that number go up and down throughout, and that's just meaning that that's the amount that's saving the county or that's the amount that is going to cost. So currently you're with Superior Vision, which is a very popular vision carrier now. They have a very strong network on both the retail, which would be like your Target and Dr. Beiser's and Walmart's, as well as your private practice. You've had Superior for quite some time. They've offered you an additional 2-year rate guarantee for the employees. This is something that's a cost to the employees, not to the county, but they've decided to hold that rate. And so we don't see any reason in changing that plan design for that purpose, especially with the cost of vision. There's no need to really change just for the sake of changing. The next we have on here is the voluntary life and disability. Both of these are paid for by the employee. Your current vendor is Humana. Your renewal date is January 1st. They also have received a rate hold, meaning no increase to the employees. I'm, in turn, however, recommending Dearborn National, formerly called Fort Dearborn National. Dearborn is a vendor that was owned or is owned by a few of the different Blues plans, which would be the Blue Cross plans across the country. They used to have all of the life insurance for the Blue Cross of Tennessee. That has since switched back in about 2004. But Dearborn is a very well-known entity. They're an A+ rated vendor, and they have a lot of business with municipal governments. We use the voluntary life and disability also as kind of a negotiating tool for the other products that might have a cost for the county. In doing so, when we looked at the other vendors, a lot of vendors either held the rates for the employees or actually increased them. The short-term disability was the most difficult part of the package where a lot of vendors didn't want to touch it, but we were able to get them to be aggressive. The short-term disability and the voluntary life part, there's no increase to the employees. The long-term disability, and they're the only ones to do this, they gave a rate reduction, and you don't typically see that too often in the voluntary side, so we wanted to make sure we were trying to get the best bang for the buck for the employees as we could, and long-term disability is a very important benefit. The reduction accounts for around 17% by my calculations for an average employee. So I gave the example, and this is an example based on some averages that we've seen that's on the long-term disability, but for a salary of $38,400 and for the benefit of 60% of that salary, that employee would see an estimated reduction in premium of around $5 per month. The worksite coverages currently are administered through Humana as well. Everything is through Humana. That renewal date is also January 1st. There is no rate increase for those plan designs. The worksite coverages would include your cancer, critical illness, your accident, whole life product, and if I said critical illness. So we looked at some different vendors. Humana, for one, is administratively has been a bear, and if you've had to file a claim with Humana, you'll know what I'm referring to. They take incredibly long to pay claims, and usually it's a fight to get them to pay for it. Overall, their overall customer service just isn't very pleasant from these products. So we looked at some different ones. Colonial is a very well-known name. They have a very good reputation in this marketplace. Colonial works a little bit different than what you'd be used to, like in an affluent market. We work with a rep that works with mostly large entities. The enrollment firm that would be used for this works specifically in the municipal government side of it. They do have some new guarantee issue available for some of the products, which is going to be very strong. What we're able to offer is going to be a critical illness without cancer rider, which means that'd cover like a heart attack, stroke, and some of the other critical type of benefits. And a critical illness policy is one that you pick the benefit amount, like let's say it's $10,000, and upon diagnosis you just receive the check for the $10,000. So a little bit different than like a cancer product where you have to file for reimbursement for every time you go in for treatment or mileage or different instances. The critical illness is you get diagnosed, you get a check. With Colonial, one of the big benefits to their critical illness is they'll pay multiple times for various different illnesses, whereas your Humana will only pay once in a 12-month period of time and will only pay once for that critical illness. The critical illness will also be available with cancer. So if you wanted to have the critical illness that had a cancer rider to it, you could without having to pick up a cancer product itself. Or if you don't like the critical illness policies, you can pick up a cancer. There's also an accident, a whole life, and then a new benefit that I'm recommending is a universal whole life with long-term care rider. So what that means is that it has similar aspects of a whole life product, and that'll build cash value. But the advantage with this product is it has the ability to pull out the death benefit to pay for long-term care needs. So it's a really cool benefit. And in today's environment, long-term care insurance, I don't know if anyone on this committee has had the pleasure of pricing out long-term care insurance, but it can be quite expensive on an individual basis. So this is a way to get the cost very low, but have a good product along with it. The whole life and universal life, anything that is considered an individual product with Colonial, just like with any vendor, wouldn't be able to be enrolled directly on Kronos, but what they do is they either, if an employee wants to be self-administered, they can use the call center, or as the employees sit down with the Colonial reps, they can enroll through that, and then the Colonial platform will upload on a daily basis back into Kronos. So all the information will still be housed in Kronos for informational purposes and reporting purposes that the HR committee would need. So I feel like this is a pretty good compromise within the platform. The big advantage with Colonial, though, is as for one, the enrollers will be available for informational. They'll be able to enroll all the products. So not only will we have the ability to have informational type of sessions with the employees on a group basis. But if the employees need to sit down and meet with the enrollers, it's not a high pressure type of sales situation. It's more of an educational process. And they'll be able to discuss all the benefits, so not just the Colonial products. They'll be able to help out with the medical type questions, dental, vision, everything, and be able to enroll through the Courthouse system directly for those products. They do require that they see at least 75% of the employees, but that does not mean 75% have to elect anything. They can waive the coverage. But the advantage with seeing the 75%, if they do that, then Colonial will provide a free flexible spending account administration with debit card if we're able to get the 75%. The really cool feature of this, and I've never seen this before, they just came out with this, and they contract through a vendor called Ameriflex, which Ameriflex is a very good vendor. They just added a feature for county governments or municipal governments that after the third year of having the flexible spending account, they will do a true up of sorts on the losses for the flex plan, and they will make sure that you're considered whole on that third year. So what do I mean by that? With a flexible spending account, I'm going to give you an example. You have an employee, Joe Smith. They're hired on January 1st. They elect $1,000 for their flexible spending account. With a flexible spending account, that employee is able to use the entire funds that first day after they elect it. So they can use the full $1,000. But the way that the county gets the money from Joe Smith on a pre-tax basis is you take the $1,000 and then let's say $1,200 for easy math. My brain is about fried on the numbers. So $1,200, and you get paid on a monthly basis, divided by 12, then $100 per paycheck comes out of his check for the entire year. So the positive is that Joe Smith has the full funds available the first day. The negative, if Joe Smith decides to leave employment as of March 1st, the county is out the $1,200 without recouping that amount for the remainder of the year. That's always been the give and take with a flexible spending account. The advantage to the county is that you get the benefits of pre-tax dollars. So the employees put in the money pre-tax, that saves the county on the taxes from that side of it. And also it's just considered a good benefit. So what this vendor is stating is that if you have multiple situations like that, and we're, to the best of our knowledge, we're trying to get some of that data. It's hard to pull out of Humana, but I gathered it was over a 3-year period, it'd probably come out to be around $30,000 that could potentially be trued up, and they would then refund you back those amounts. So essentially, you're not at a loss. So it's a really good benefit. Never seen it with anyone else. And they're able, again, to enroll in the Courthouse software. And as far as this is what I thought was a great stat, the enrollment team that would be here has a 90% retention rate on the products that are enrolled. So what does that mean? Those products, historically speaking, have a bad reputation of people coming in and not taking no for an answer. I don't know if you've ever experienced that. On my side of it, I've experienced people that have done that, and I don't care for it at all. So what inevitably happens is you have people enroll in benefits that they don't need, and they end up paying way too much out of their paycheck for those products, and then they end up dropping the product 2-3 months down the road, which becomes an administrative burden on the HR team as well. What they're stating is that they have 90% retention, so 90% of the time they don't have anyone drop the product after they've enrolled. So it means that that person really got what they wanted. They didn't feel like they were oversold, which is something that we always look for when we're looking at these vendors. Any questions on the worksite products and voluntary products? That's the easier part. From a contractual standpoint, the benefits are either as good, if not better, than they were before. From a cost standpoint, they're either as good or better than before as well. Okay. If there's no questions, I'll move on to the next part of the agenda item, which is going to be more of the county cost items. First on our agenda is going to be the stop loss. Your current carrier is HM Life. This is a vendor that is owned by some of the Blue Crosses and very well-known, very large stop-loss carrier. Your current stop-loss coverage level before 2015 of July was $250,000. Your initial renewal was 45%, if you recall, when we had the meeting a few months ago. That attributed to an increased cost of $277,000. If you recall, the last meeting, the day of, I received an updated proposal from HM Life. I was coming in here to recommend a group called HCC Life, which was coming in with a 29% increase. At the last minute, HM Life came back and reduced it down to a 25% increase for the current benefit, which would have been an increased cost of $154,000. So then we looked at how many times have you had people hit the $250,000 stop loss limit. And to back up, again, the stop loss, what that means is that if you have an individual, let's say they have a bad accident, they're in the hospital for 30 days and have $700,000 in medical claims, the most that the county will be liable for that individual person would be $250,000. From that point forward, the stop-loss vendor will pick up all the remaining costs for that person for the remainder of the year, so just for that individual person. When we looked at this, you at most have had 3 individuals hit that stop-loss level. You average anywhere between 2 and 3 over the last 4-year period. So we looked at it, the $300,000 specific stop-loss actually provided a decrease in your premiums of 2.9%, which comes out to a savings of $17,842. Your break even on this product was really right at 4 people hitting it. So I feel comfortable in recommending that we increase the stop loss limit to $300,000 and take the savings. You'll see in the top right corner, this provides our first ticker number of $17,842 for our savings. I do understand that this also means that you're going to have greater liabilities in the claims, and that will be adjusted for in the back end when we get to the claims piece, so that this is going to be accounted for in the claims part of it. As our previous meeting, the question was asked, how much do we have in pending reimbursements on the stop loss? As of June 15th, we only had $40,881 that has not yet been received by Blount County and stop-loss payments. And in speaking with Jenny, some of that has been received since now, so there's very little.
Yeah, I think we got a check last week for about $18,000 of that, so that's less $18,000
Yeah.
we still have available to be reimbursed.
Yeah, so our last meeting, the thought or the hope was that we had a lot of pending reimbursements, and unfortunately that's not the case. So we are expected to get a little bit more back, but not the 6-figure number that we were originally hoping for. All right. So let's go on to the dental insurance. You're currently with Blue Cross Blue Shield of Tennessee. You've been with Blue Cross Blue Shield for many years. If you recall, earlier in the year, they were anticipating an increase of 6% for July 1st. We were able to get them to extend that out to January 1st. And that was a common theme of Blue Cross, to extend it out, push it out, push it out. They told us at the time that they're not going to be able to push it out anymore. So January 1st, they are providing another 6%. I was able to revise it down to 5% based on a rate hold from MetLife. But it's still 5% increase, which what that means is they will do a 2-year rate guarantee stating that they won't increase your rates the next year, and then that with a cap of 5% for the 3rd year. So that means for 3 years from now, the maximum they could increase your rates would be 5%. This does an increase to the county portion itself. So the county currently contributes the full cost for the employee-only rate for the dental. So this is just pertaining to the county's cost. So this would be a $13,650 increase on that part. MetLife provided a rate hold, and the average increases with MetLife have been around 7% annually, and they do have a smaller network of providers. The reason the ticker hasn't changed is, if we go to the next slide, last week we received a quote in from Delta Dental. So in your packet you'll see that Delta Dental shows is not being received for the product. Reason for that is we just got it in. But they were very quick to turn this around on the provider network information. We were able to get a reduction with Delta. They were the only ones initially to give us a reduction in the cost. They have the largest national network out of all the vendors. If I was to take a poll, I'd say 99% of you all have heard of Delta Dental. and knew they did dental insurance. In Tennessee, they have 89% of the dentists participate in the Premier Network. In the PPO network, they have 63%. And then they're quoting you an 80th percentile of usual and customary for out-of-network. So that sounds like a lot of insurance jargon. What does that mean? That means that Delta Dental has a very unique offering in that they provide the Premier and the PPO simultaneously. So if you have a dentist that's in the PPO network, good for you, because you're going to get a little bit deeper discounts for those benefits. If they're not in the PPO, but they're in the Premier, then you still get in-network benefits, and they're provided at a very strong level, and that you do get some discounting. Let's say that you have a dentist that just doesn't take insurance. I'm sure there's a lot of us that have those dentists that don't take insurance. Then that's why the out-of-network benefit is really important. The 80th percentile of UCR, what that means is that Delta Dental will pay out what 8 out of 10 dentists charge for that procedure in that geographic area. So they'll take all of the codes for those dentists in that region and then figure out the average cost. And if your dentist charges what 8 out of 10 dentists charge, let's say for a cleaning, then you'll have no balance billing and you'll have the full cost covered. If you have a dentist that charges $5 more than the average cost, then you'll have a $5 difference. So if you do have any out-of-pocket costs, which are going to be rare, one, that tells you that your dentist is very proud of their work, so it's going to have some higher costs. But two, it's going to be just a little bit more expensive. It shouldn't be dramatically more. So it's a really good benefit. Delta Dental is also providing a 2-year rate guarantee. So you know that if they're buying up the business, then so be it, because they're stuck with the rates again next year for 2017. And then in 2018, the maximum they can increase their cost is by 5%. Overall reduction on the total monthly premium is going to be the $41.67 per month, and then so that equates to $49,000 in annual reduction for the Delta Dental. This is what it looks like on the employee basis. I broke it down on the accounting cost and the employee cost. The current is $23.51. Sure.
Okay. All right.
You're good. All right, so the current cost for the employee only is $23.51. If you're an employee, we have a 2-tier network. We did look at what it looked like to go to a 4-tier. So what that means is a 2-tier, as you can see, your rate options are employee only or family. So the negative is if you just have a spouse, you're paying the full family rate. Or if you just have a child or children on your policy, you're paying the full family rate. 4-tier network would be like your medical and your vision. That would be employee spouse, employee child, and family. In doing this, we were able to pull data from Blue Cross to see how many of the people that are in the family have just a spouse or just children. And unfortunately, you have over 500 true families on your policy. So if we were to go to a 4-tier network, that family rate would go upwards of over $90 per month. So the families would see an increase of right around $30 per month. So that you had far more families than you did other tiers, and it equated to a monthly plan total increase of around $2,000 a month. So it didn't make sense to move it to the 4-tier, so we decided to leave it at 2-tier right now. The renewal with Blue Cross came to $24.69. The family rate went up to $51.70. The proposed with Delta Dental dropped the employee-only rate to $22.14. And then the family rate to $47.32. So the families get a slight decrease in cost as well. So then we go into the life insurance. This is the one that probably shocked me the most. We received in some quotes. A lot of the quotes came in around what you're paying right now, if not a little bit less. A few came in quite a bit more. Your current carrier is with Humana. Your overall spend on the life insurance is $192,000. This is paid for by the county for the employees to have a life insurance policy in place, which is a very good benefit. A lot of employees only have life insurance through their employer. A lot of them don't have their own individual policy, so it's very strong to offer that. The renewal with Humana was a rate hold. Dearborn came in, and as mentioned on the Worksite products, they came in with a very good product. They're A+ rated. They came in with a savings of $86,000. This is true savings to the county, and this is on life insurance. So savings of $86,000 on life insurance is incredible. It's a 2-year rate guarantee. They essentially cut your rate in half. So, yep.
How much insurance are we talking about per employee, and does that stay the same?
The benefit amount stays the same. It's at $50,000. Up, okay. Go.
Okay, thanks. It's up to a maximum of $50,000. So it's 1 times your annual salary, but if you make more than $50,000, then it would cap at $50,000. So if you make $25,000, we would give you $25,000.
Also, the other benefit to this, and thank you for asking that, I almost didn't mention it, is whenever you exceed age 65, any life insurance policy will typically have a reduction schedule in place, right? So this also has a reduction schedule in place, but your current policy will reduce at 50% at age 70. This policy reduces by 50% at age 75. So as we know, that age difference between 70 to 75, that is a very strong benefit that you don't see too often. So this is a benefit upgrade, which is odd to say with life insurance, but it's a benefit upgrade at a far reduced cost. So you'll see our ticker goes up to 173. And then we get on to the fun part, which is going to be the administrative services. You're currently with Humana. The annual spend for this is $665,000. The administrative services are going to be Humana is the provider that pays the claims. So they pay with basically your checkbook to pay the claims to the providers directly. If you didn't have Humana, you would have to have people inside of Blount County writing the checks out to each individual provider, as well as you wouldn't have the Humana network. So you would essentially just have the Blount County network. So Humana does all of those. They also do some of the compliance services. Your renewal date is January 1st. You have a slight reduction of 3.2% to $644,000. The reason for that is for some prior billing issues with Humana. Thus also the reason why we were looking outside of Humana. Their customer service is lacking, is a constant fight to get correct data from Humana. Including data and billing. I'm sure the HR individuals in here would back me up on this. The lag time on reporting to even get the reporting can take months at a time for something that, for one, we should be able to run ourselves, but we have to request. And then also the amount of time it takes is terrible. And then the administration, everything is a process with them. With them being purchased by Aetna, I anticipate that, and it will eventually probably get better because Aetna is just a better provider for your size of a company or a group. But there's going to be some growing pains, just like you received from going from Keratin to Humana. Those growing pains I don't think ever left. But going from Aetna to Humana would have even more growing pains before it got better, in my opinion. So the negative about moving from administrative services. Under a self-funded platform, the way it works is that you have what's called run-out claims. So with your run-out administration, Humana charges, and this is in your contract, but they charge 8% of 2 months' worth of claims. So they take the last 2 months of claims, so unfortunately I'm going off of a projection, off of the average. But they will administer your run-out claims for a period of 18 months. They do require that administration cost, though, to do that, but that'll be the most they'll charge. I'm estimating that to cost $245,000. So what does that mean for the run-out? So under a self-funded plan, it's based on when the pay date is for the contract. So even though your contract is through December 31st and you have a claim that's incurred in December, whenever it's paid is how the administration works. So in the example I gave, John Doe has a $1,000 claim on December 3rd. The claim is submitted by the provider on January 3rd. The claim is paid by Humana due to the data service and the use of Humana's network. So unfortunately, the reason why they'll administer claims for 18 months is inevitably you're going to have claims that were incurred in 2015 that might not get completely paid until the end of 2016 or even 2017. The reason for that is sometimes the provider will file a claim but not file all of the correct information, so then they have to go back, or they'll file a claim that's originally denied, and then they'll go through the appeals process to get approved. So there's many reasons a claim can be a run-out situation. But while the new carrier could administer this, even as terrible as Humana might be, it would be even a greater disaster because the new vendor would have to try to price claims out on Humana's network. So it makes it very difficult. So typically you have the current administrator administer the run-out. The question was asked earlier, are we getting raked over the coals for that amount of cost for the administration? Usually you see the cost, and the one that we're recommending to go with, in their contract, they're stating if you ever leave, they would charge 4 months of administrative fees to do it, which equates to a little bit less than this cost, but it's around the same. We have an individual on staff that used to work at Blue Cross Blue Shield in the account management side. They also typically charge 8%. So this is a very normal type of cost for this. So you'll see, unfortunately, that means our ticker went in the red. So what's our recommendation? Allegiance. Allegiance has probably not been heard of by anyone in here. What Allegiance is, though, is wholly owned by Cigna. So they are a reputable company. They are the TPA arm of Cigna. The reason that we're looking at a TPA is due to your custom needs for the county. You have a private network. You have multiple different benefit options that are not typical with a standard company. You have different provider relations even outside of the Blount Memorial network. And then also you have many different vendors. So this TPA is considered a boutique TPA, and they specialize in government and hospital entities. So before they were acquired by Cigna, they were started in Montana, and they were started by hospital chains, which then moved into county governments. So it was very neat in checking their references to see how the clients that they have are very similar to Blount County's makeup. And also, they're long-standing clients. We did a finalist presentation. So the process, we went through the different vendors. We narrowed it down to UMR, Allegiance, and Blue Cross Blue Shield, and we had them in for a finalist presentation. Allegiance, far and above, gave the best presentation.